Welcome to this explainer. Look, if you're trying to get a handle on your finances, you already know that just the thought of borrowing money can trigger a ton of anxiety, right? But what if we took a step back and looked at a strategic roadmap to completely demystify personal debt? Today, we're going to figure out how to view debt not as this chronic source of panic, but actually as a highly predictable tool to build your financial future. Okay, let's dive into this. Here is the exact route we'll be taking today to logically navigate our way to your financial health destination. First, we'll cover good versus bad debt. Second, student and car loans. Third, avoiding the debt trap. And finally, strategies for debt repayment. All right, stop number 1, good versus bad debt, mapping the landscape. To navigate all this properly, we first got to recognize the terrain we're standing on. Basically, debt is just a tool, and we need to break down the stigma because not all borrowed money is created equal. On one hand, we have productive borrowing. Think mortgages or an education. These act as structural building blocks. They're an investment in your future that actually increases your net worth or earning power over time. But then, on the flip side, we have harmful habits, like racking up high-interest credit card debt. That stuff, it acts exactly like financial quicksand, just draining your resources without adding any real intrinsic value to your life. Let's actually test this out with a relatable, real-world dilemma. I want you to imagine you have a choice to make right now. Should you finance an absolutely incredible luxury vacation entirely on a credit card, or should you take out a student loan to fund a new degree or certification in your field? Now, both of these require borrowing money. Both are putting you in debt, but their trajectories completely opposite. Let's see how they actually play out. Now, what's really interesting about this comparison is just how drastically different the long-term consequences are. That luxury vacation, it's a depreciating asset. It's tied to very high interest rates, which is essentially a direct hit to your net worth. Meanwhile, the degree is an appreciating asset. It positions you for real, exponential career growth and generally comes with much lower interest. You borrowed money in both scenarios for sure, but only one of them is acting as an actual stepping stone. Let's move to Section 2 and see how this builds as we navigate some specific, everyday landmarks. Student and car loans. So a pretty massive landmark on most of our financial maps is student loans. And the absolute, critical, high-level difference you need to know here is federal versus private. Federal loans generally offer standardized interest rates and some highly flexible, income-driven repayment options. Private loans, on the other hand, well, they are heavily dependent on your personal credit history, and they offer way less flexibility if you hit a rough patch in life. Honestly, knowing exactly which one you hold completely dictates your long-term strategy. Next up, let's map out car loans. While having a vehicle is often totally essential, we have to remember a car is inherently a depreciating asset. It constantly drops in value. That makes the mechanics of financing it absolutely crucial. For example, when you stretch a car loan out to 72 months instead of, say, 48, sure, your monthly payment drops. And yeah, that definitely feels like a win today. But mathematically, you are paying significantly more in total interest over time on something that is actively losing value the absolute second you drive it off the lot. Now we're moving our map into some dangerous territory. Section 3, avoiding the debt trap. Hazard ahead. I really want you to think about this number for a second. 24%. This isn't just some random statistic. It represents a dauntingly high, yet honestly remarkably common, credit card interest rate. This number right here, this is the gateway to the debt trap. The trap fully springs shut on you when you combine an intense interest rate like this with the habit of only making the minimum payments on your balances. At that point, the vast majority of your hard-earned money is literally just covering the bank's interest fee. You are barely even scratching the actual principal balance. And this brilliantly illustrates the invisible threat of compounding interest. Look at that exponential leap between year 3 and year 5. Because interest compounds, meaning it literally builds on top of itself, a super small initial balance, left unchecked, transforms into a massive, massive burden. You haven't even bought anything new, yet your debt has grown exponentially. This is exactly that financial quicksand we warned about earlier. Okay, let's get to the resolution and empower you to escape. Section 4, strategies for debt repayment, the fastest route. So the first route out of here is called the snowball technique. This method is incredibly powerful, mainly because it focuses on human psychology rather than just pure math. Basically, it involves paying off your debts starting from the absolute smallest balance all the way up to the largest, completely ignoring the interest rates.
Since personal finance is, largely behavioral, knocking out those small debts super quickly gives you immediate psychological wins. Actually seeing an account zeroed out, that builds the fierce motivation you're going to need to conquer those bigger balances.
Here's exactly how you can execute this in your real life, step by step. Step 1, list out all your debts by their balance size, from the smallest to the largest. Step 2, maintain the minimum payments on everything else so you avoid any nasty penalties. And step 3, throw absolutely every extra dollar you have at that smallest balance. Once it is completely gone, you take that payment power and roll it right onto the next smallest one. It's literally like a snowball rolling down a hill. Your momentum just keeps building and building. Now, the second route is called the avalanche technique. If the snowball method is all about psychology, the avalanche method is about pure, brutal math. This approach involves paying off your debts from the highest interest rate down to the lowest interest rate. By systematically attacking those highest compounding interest hazards first, you are stopping the absolute most expensive financial bleed. It mathematically guarantees that you will pay the least amount of interest possible. For the avalanche, the procedure looks a bit different. Step 1, rank your debts by interest rate, highest to lowest. Step 2, again, pay the minimums across the board on all of them. Step 3, attack that highest interest rate debt relentlessly. So, the crucial point here is that this requires immense discipline, simply because you won't get those quick psychological wins as fast as you do with the snowball. But mathematically speaking, this route saves you the absolute most cash in the long run. Well, we've officially mapped the terrain today, all the way from understanding productive borrowing right through to executing some really aggressive repayment strategies. But before we wrap up, I want to leave you with a provocative question to consider as you look at your own finances today. If debt is truly just a tool, take a hard look at your current balances. Are you using that tool to actively build your future, or are you accidentally dismantling it? The choice of how you navigate from here is completely yours. Thanks so much for joining this explainer, and I really hope this roadmap helps you take that first empowered step today.